With a clear picture of what healthy markets look like during uptrends, let's continue forward towards the end of 2014, where the Dow Jones Industrial Average, representing the overall stock market quite well, underwent a larger correction. It's still within the small category, but just barely, as it's nearly a 10% drop. The overall uptrend continues, however, as 2015 begins, more volatility begins to emerge around the new record highs in the 17 to 18,000 ranges, and that higher volatility definitely shows some distinct instability compared to what was seen in the past year and a half. While these categories are useful, keep in mind they are still approximations, and sometimes one criteria will be met, such as the magnitude of price drop. However, it might happen during a longer or shorter duration, making the classification more difficult between small correction, medium correction, and large correction, becoming a stock market crash. Though as the chart continues towards the 2015-2016 time period, there is definitely no confusion here, as there are classic corrections within the 10 to 20% range lasting for a couple weeks. Now, a couple key things to note here. In general, it takes longer for the market to recover and rise than it does to drop. Normally that is because fear with the onset of a medium to large correction happens quite rapidly, as many market participants become fearful and sell off quickly. Whereas when the market recovers during an upswing of any magnitude, it takes longer, as market participants are more hesitant to re-enter the market following a large drop. Downswings may also take some time to form, such as what has been seen here. However, normally during the first approximate week, the decline is quite rapid, and after that there may be a temporary supporting range, such as what is seen here around the low 17,000s range for both the medium-sized corrections. At the start of these medium-sized corrections, the initial downswings are quite similar to the prior example demonstrating small corrections, in terms of the drop being about 10% or less and lasting for a period less than 1 month. But after that, the differences emerge. First, in that the market does not continue breaking past the previous highs and instead continues sideways or slightly lower, often with uncertainty and volatility in the form of rapid movements in price, sharp upswings and downswings in this temporary supporting range. And the key event here is when the temporary supporting range, in this case, both cases, it's at the 17,000 area. Once price decisively moves below that, it goes from a small correction to a normal medium-sized correction between 10 and 20% lasting for usually over 1 month. And upon this break into the 10% threshold, lasting for more than 3 weeks, the market declines quite rapidly once again, similar to the very start of the downswing, and it does not become a large correction because it does not cross the 20% threshold, nor does it last for more than a 6-month period. And that is quite apparent here. These are normal-sized corrections. Quite volatile, but they are definitely not stock market crashes. It will be common for popular culture to call drops such as these stock market crashes. However, that would not be entirely accurate. They are just very good examples of medium-sized corrections, quite normal. Because often markets can recover from medium-sized corrections within about a year and even continue to new record highs, such as the Dow did here, jumping ahead 2 more years to the beginning of 2018, where it began reaching the mid-20,000s range. So in that respect, the second example with medium-sized corrections is almost like the small corrections, except of course on a larger scale. The market corrects by dropping down to correct overvaluation and overbuying, and it eventually continues higher. The first drop in this case of about 12% is a great example of the market making a very sharp peak and reversal following a very steep rise. It was very much overextended to the upside both in the short, medium, and long term, so it was quite natural for the sharp drop to take it well past 10% within a very short period of time. However, after that, the market does become overextended to the downside, which formed that temporary supporting range and eventually reversed back up. So in that respect, it just barely fits into the medium correction category in terms of the price drop. However, the time duration is more like a small correction, lasting for barely 3 weeks. So it's a bit of a blur between the two categories for that first drop. Things may have seemed very unclear, particularly during the formation of that first initial drop. However, the important thing to note was that the initial supporting range around the 10% threshold was not broken through. In fact, the market began to move neutral to slightly upwards in the subsequent weeks. And the market was quite volatile for several weeks after that second initial drop. However, similar to the first case of the approximately 12% drop, this was still close to a small correction, dropping about 9.9% in the first initial phase, where the temporary supporting range also formed. This is actually quite similar to the second case we looked at with those medium-sized corrections, in that the market does make smaller upswings, but they do not get past the initial peak where the downtrend began to form. And after several more weeks, the market eventually broke through that temporary supporting range around the 10% threshold to initiate the second phase with a very sharp decline to continue lower, and in this case it was just neatly within that medium correction category between 10 and 20%. All in all, both these drops are great examples of a neat boundary between small corrections and medium-sized corrections, with the key takeaway being to watch that approximate 10% threshold. Once the market forms that temporary supporting range and begins to break below it, there will be a normal drastic drop that follows. In this case, the critical 10% threshold was approximately around the 24,500 range, and in the case of the first drop, about 12%, it pierced it briefly but was unable to continue lower, so it remained within the realm of a medium-sized correction, just barely, and overall it was more like a small correction that was more volatile. However, the second drop demonstrates once that key 10% threshold is broken through, the market continues sharply lower. In fact, the market became sharply overextended and oversold. That is why it was quite natural to see the opposite happen, with the market rebounding very rapidly. And after the initial sharp recovery back up, there was natural resistance around that key 10% boundary around the 24,500 range, and further on back up as it stabilized, there was further resistance back at those all-time highs near the 27,000 range. Very normal recovery and resistance. Going back to the Crashometer, we can see that those past few examples have been quite progressive in going from small to medium-sized corrections. Now we'll put concept into practice and see what happens when the price drop goes 20% or higher and lasts for more than 5 months. Winding the clock back about a decade from the last example, we see the 2007 to 2009 recession, most commonly called the Great Recession of 2008, a very good example to begin demonstrating the threshold from medium correction to full-scale stock market crash. In mid to late 2007, just before the crash begins, the market was still on an uptrend that was gradually slowing down. So it was definitely not a sharp peak, which is why the market didn't drop as rapidly to begin with. But nevertheless, there was still that approximate 10% drop forming a temporary supporting range where there were some initial quick spikes down. If the market was rising more rapidly prior to the crash, similar to what was seen in the 2018 time period in the last example, the initial drop may have been considerably sharper. As 2007 drew to a close, the market began making lower lows and lower highs as each subsequent downswing and upswing brought prices slightly lower, and that eventually crossed the 10% threshold, initiating a sharper drop to accelerate the market down to begin 2008 near the 20% threshold for a stock market crash. So far, it's quite similar to the previous examples in terms of the price drop and the time duration. However, we obviously see that it went way past 20%, but at the time, in the first half of 2008 especially, it wasn't as clear because it resembled a medium-sized correction similar to the previous examples. It just barely reached that 20% mark and began a medium-term uptrend. But remember, there will be resistance at key natural levels for the medium-term uptrend, and in that case it was around the 13,000 mark, where the approximate temporary support range formed near the 10% threshold during the initial drop. So once the market recovered back up to there was natural resistance, and since it was unable to pass that, it went back down to retest those previous lows. That is in sharp contrast to the last examples where the market reached that resistance area of the 10% threshold and was able to continue higher. Then when focusing on the boundary from medium to large correction, in this case it was near the 12,000 level to begin. There was major contention there as well, which is quite natural because as we move between the small, medium, and large categories, there will naturally be contention at those key boundaries in the form of support and resistance, and that was definitely the case here. In latter 2008, there was major back and forth, but eventually once that major level was broken through, the 12,000 level, the market was heading towards bear market territory, and that initiated the next sharp drop downwards to take it into a full-scale recession, and it can technically be called a stock market crash. Next is a chart of the Nasdaq Composite Index. Similar to the Dow, it is a representation of the broad stock market, and during the same approximate time frame for the 2008 recession, the Nasdaq dropped about the same amount as the Dow, so in general they are both great representations of the broad stock market. However, when we look at the financial sector with the financial sector ETF here, composed of mainly financial stocks of course, it fell considerably more during the same time period, which is quite natural given that the 2008 recession and stock market crash were financial based, with many banks having difficulty during that time. That is why a major stock in the financial sector, Bank of America, had considerable difficulty and underwent a drastic drop during that time. A similar situation can be found with the 2000 crash, also known as the tech bubble stock market crash, where many technology and internet-based companies in the late 20th to early 21st century had declined significantly. The Nasdaq Composite Index demonstrates this quite well, as it is a broad stock market index representing the broad stock market. However, it is slightly more tech-oriented with more tech stocks composing it. A major tech stock at the time was Microsoft, and unlike Bank of America, during its decline in the 2008 recession, Microsoft, although it was tech-oriented, remained quite strong, so that is why it was natural to see it drop less and recover relatively quickly in the subsequent years. And although a company and its stock, such as Microsoft in the early 21st century, can be quite strong, they will still face difficulty during market declines, even if those market declines do not directly affect their respective sectors. exemplified quite well with Microsoft still declining significantly in 2008 during the financial-based recession, even though it was a technology stock. Overall, all these charts were great examples of ordinary stock market crashes, the natural transition from medium to large correction. Certainly there will always be some variation, but these charts demonstrate the clear distinction going from a medium correction to a large correction with a drop of at least 20% lasting for about half a year at the minimum. That is why the boundaries set out by the criteria of the crashometer are useful guidelines in gauging when a drop crosses certain thresholds to go from small to medium to large correction and eventually a full-scale stock market crash.